Do you know what happens to your most tax advantaged account when you pass away? Do you know how to efficiently pass on this account? And no, I'm not talking about your Roth IRA, although that can be a very tax advantaged account if used properly within your retirement. I'm actually talking about your health savings account, otherwise known as your HSA. Now, this is an extremely powerful account because it can completely skirt the IRS tax code. You can avoid paying taxes on it altogether, again, if used properly. But as tax advantaged as this account is while you're still alive, when you're passing it on to the next generation, it can become a very tax disadvantaged account. And so in this video today, we're going to be talking about how you can get the most out of this tax advantage account in your retirement and make sure that you pass it on efficiently to the next generation or another given entity. And so let's get into it. If you're not sure what an HSA is, it is a health savings account. It's an account that you specifically save for and use for qualified medical expenses. If you use this account for qualified medical expenses, it is your most tax advantaged account. The reason being is because it combines the best benefits of a traditional IRA as well as a Roth IRA. When you contribute to these given accounts, there is no tax on the contribution, similar to how a tax deferred account is. You actually get a tax deduction. There are no taxes on the growth as this money is growing. And then when you withdraw this money for qualified medical expenses, you will not owe any taxes on that withdrawal at all. And so the money that you put into this account, if used properly, completely skirts the tax code altogether. And so for a married couple in 2022, the max limit for how much you can contribute to these given accounts is $9,300. That's $3,650 for each of you that you can contribute. And then there's a $1,000 catch-up contribution if you're over the age of 55. Now, if you're not sure what an HSA is, or you want to learn a little bit more about these accounts and strategies you can use with these accounts, I highly recommend watching 2 trainings that we previously recorded. The first is talking all about what an HSA is and how you can use it within your retirement. I'll link to this video in the upper right-hand corner, and it explains all of the different ways you can qualify for an HSA and also what qualified medical expenses are that you can use this HSA for. The other video that I'll also link to in the upper right-hand corner is all around a very powerful loophole that you can use called the HSA Receipt Loophole. And you can use this loophole in order to get more out of this account. You can, again, grow this account at a little bit faster rate by using this loophole within your retirement. Again, I'll link to that in the upper right-hand corner. Highly recommend watching both of these if you're not really familiar with what an HSA is or how you can use it powerfully in your retirement. Now, if you haven't seen these 2 trainings, it might be because you're not yet subscribed. And so make sure you hit the subscribe button down below so you're notified of all future videos that we release. And so let's get into it and talk about the different ways that you can pass on your HSA when you pass away, and the different tax ramifications of passing on in each of these given strategies. So the first and most tax efficient strategy is passing on your HSA to your spouse. And so let's take a situation here where we have John and we have Sarah. They're married, and John's grown a larger HSA than Sarah has. The reason being is because we'll walk through essentially how they can reach this contribution limit and talk through why John has a larger HSA. So in 2021, again, they could contribute as much as $9,200 between the two of them. They're both over the age of 55. Now, it's important to note that you don't have to make your contribution to separate accounts. For that $3,600 in 2021 that each spouse could contribute, you don't have to make that to separate accounts. You can actually make that all in one account. The reason being is because while you're married, your HSA can be used by either spouse as well as your dependents to pay for qualified medical expenses. And so you can do the main contribution both to the same HSA. You can also do one person's catch-up contribution to the same HSA. And so how this works out in 2021 for this couple is John and Sarah made their $8,200 contribution to John's HSA. They've been doing this historically, making the larger contribution to John's HSA. That's why it's grown larger. But to make that final $1,000 catch-up contribution, you need to make the last catch-up contribution to a separate HSA. And so it's wise for each of you, if married, to open separate HSAs so you can make that additional catch-up contribution. They can't make that additional catch-up contribution to that same HSA. And so what's happened over time is John's grown a much larger HSA because they've been making those larger contributions versus Sarah's HSA. Now, what happens when John passes away? Sarah can simply roll over John's HSA into her HSA. There are no tax ramifications for doing so. She can basically adopt that HSA in the same way that she could do that with an IRA or a Roth IRA. She can simply roll that. And so John's $132,000 HSA combined with her $18,000 HSA, and now Sarah has a $150,000 HSA. And by doing this simple rollover, Sarah can maintain the tax advantage status of this given HSA. As she has qualified medical expenses, she can keep using those. She can use the receipt loophole to claw back previous HSA or qualified medical expenses, and also keep growing this money tax-free for the future. And so passing on an HSA to a surviving spouse is pretty simple, but what happens when that surviving spouse then passes away? So let's say the following year, Sarah passes away. She still has $150,000 in her HSA, and now their son Jeff is the beneficiary of that given HSA. Now this is where this extremely tax advantage account starts to become tax disadvantage. When you pass on your HSA to another person but a non-spouse, that HSA becomes fully taxable in the year of death. And so when Jeff inherits this $150,000 HSA, he can't simply roll it into an HSA that he might have. Instead, he has to withdraw the full amount, and that full amount becomes taxable in that given year. Now, it's important to know that HSAs avoid probate, but nonetheless, this becomes a very tax disadvantaged account because inheriting a very large HSA and having it all taxable at once is likely going to push Jeff into higher tax brackets and thus drain that HSA due to a tax drag. Now, if applicable, there is a window of opportunity that both Jeff should know about as well as you if you're put in one of these situations of inheriting an HSA. When you've first started that HSA, there's no time limit on, as you've incurred medical expenses, if you paid those medical expenses out of pocket, there's no timeline on when you can essentially drain that HSA for those given medical expenses. This is something called the receipt loophole. So let's say that you started an HSA in 2005. In 2006, you had $3,000 in medical expenses that you paid for out of pocket. Well, if you've kept the receipt and you haven't taken that $3,000 out of your HSA, you can use the receipt loophole and at any point in the future, take that $3,000 out of that given HSA and be able to take that out tax-free. Because your HSA was originally started, you had qualified medical expenses, but you simply paid them out of pocket. And so you're essentially clawing back some of those qualified medical expenses. Well, even after you've passed away, there's a 1-year window from the date that you passed away where your heirs or estate can essentially claw back those given receipts. Now, it's very important to keep receipt documentation if there were any given medical expenses that you didn't take from your HSA. And so in someone's given situation, this could add up to a lot of tax-free dollars that can be pulled from that HSA within this clawback window. And so even after you've passed away, we can still be using that receipt loophole for your benefit to pass on tax-free dollars to the next generation, if used strategic. Third way to pass on an HSA is to pass it on to a non-person, an entity. And this would be if Sarah passed on her HSA to Sarah and John's trust. And this is a very tax disadvantaged way to pass on your HSA. The reason being is because once the trust inherits that HSA becomes fully taxable in the same way it would if it was passed to Jeff. The difference being is the tax ramifications are completely different. So once that trust has taken the given deductions that it's eligible for, that HSA is now fully taxable, but it's taxable at trust rates rather than income tax rates. And so trust tax rates are very high. You want to avoid your HSA becoming taxable to the trust. As you can see here, after given deductions, any amount over $13,451 is taxed at the highest marginal income tax rate of 37%. And notice it ramps up pretty quickly. It goes from 10 to 24 to 35 to 37 pretty fast. And so generally the worst way to pass an HSA on is passing it to a given trust. And now finally, the fourth way of passing on an HSA, and this time we're passing it on once again to an entity, is actually fairly tax preference. So this is looking at passing on your HSA to a charity of choice, a 501(c)(3). And when you pass on that HSA to a charity, that charity is able to withdraw that money completely tax-free. And so once again, there are no tax ramifications of that inheritance there. And so this can be a great way to pass on your HSA if you're charity minded and you would have to pay very high taxes to withdraw that given HSA. Your heirs would have to pay fairly high taxes and you want to give to a charity of choice anyhow. And so what is going to be the most tax efficient strategy for your situation? Well, first off, we want to make sure that we're utilizing your HSA while you're still alive. But let's say that your HSA grows too large and you don't have enough qualified medical expenses to fully drain that HSA. What are your options? Well, it's important to note that after age 65, your HSA is treated very similarly to a traditional IRA, if not used for qualified medical expenses, beside the fact that this HSA will not have RMDs. And what I mean by this is when you withdraw money from an HSA for a non-qualified distribution, that money becomes taxable to you, just as you would if you withdrew money from your traditional IRA. Again, the difference being is the HSA does not have a required minimum distribution, so you'll never be forced to take from that HSA. And so depending on your tax liability versus your heir's tax liability, it may make sense to make some non-qualified distributions while you're still alive. Again, if that HSA has grown too large and there's no way that you're going to have enough qualified medical expenses to use that money tax-free. The other thing that's very important to understand is what all qualifies as a qualified medical expense, so we can gain the most out of this tax advantage account. Now, the IRS released Publication 502. I highly recommend looking at this Publication 502 to look for all of the things that qualify as a qualified medical expense. Again, we want to be utilizing that as much as possible within our own life, because when we withdraw that money for medical expenses, it's tax-free. When we pass that money on to the next generation, it won't be tax-free. But what happens if you can't exhaust this full HSA and you pass on? How can you pass this on most tax efficiently? Well, first, the most tax advantaged way is to pass this money on to your spouse. Again, that spouse can simply roll it into their HSA. There are no tax consequences for doing so, and they can continue to utilize the tax-free capabilities of this given account. Number two, if you're charity-minded, we'll be passing this money on to a charity. Most other retirement accounts, like a traditional IRA, like a Roth IRA, when passed to the next generation, they have a lot more than just 1 year to fully withdraw that money. And so passing on an HSA is much less tax preference than passing on some of your other retirement accounts to the next generation. And so if you're charity-minded, passing that on to a charity, that charity can withdraw that money tax-free. The next two can be interchanged, and they can be interchanged depending on your tax liability versus your heir's tax liability. So let's say that we're looking at passing this on to a non-spouse. Well, if that non-spouse is in some lower tax brackets than you would be in as you're withdrawing from that HSA, it oftentimes makes more sense to pass that HSA on to that non-spouse. Yes, this isn't exactly tax advantage because, again, they'll have to withdraw all of that money in 1 year, but it will be more tax advantage than you trying to withdraw that money. Now, this can be interchanged out with you passing this HSA on to your estate. You would pass this HSA on to your estate if your tax rate is lower than what your heir's tax rate would be. Now, we didn't exactly cover this, but when you pass an HSA on to your estate, it becomes a fully taxable event at your death, and it becomes fully taxable on your final income tax return. And so when you leave an HSA to your estate, if you're in some lower tax brackets, yes, it will become fully taxable at your tax rate. But again, this is with the assumption that your tax rate is lower than your heir's tax rate. Finally, the worst and most tax disadvantaged way to pass on your HSA is passing it on to your trust. Again, it will become fully taxable to that given trust at those high trust income tax rates. Hopefully this video was informative and taught you how to get more out of your HSA while alive as well as after death. If you like this video, please hit the like button down below. It will help other retirees just like yourself find this video and hopefully gain some value from this video, as well as hit the subscribe button so you're notified of all future videos that we release. We release videos on a weekly basis. Always remember that you don't need more money, you need a better plan. Thanks for watching. We look forward to seeing you in the next video.